Good morning, everyone, and welcome to this Business Day Financial Mail Investment Dialogues live in partnership with Brenthurst Wealth. I'm Alishia Seckam. I'm an anchor at Business Day TV, and I'm going to be chatting to you through the course of this next hour, facilitating this conversation that's looking to explore some of the global themes, economic, political, social, currently at play, and how that should be influencing not only how, but where you build your wealth. Now, in our newsroom, every day we've got the spotlight on markets, the news impacting investor sentiment and investment decisions, and then the kind of activity it ultimately triggers on markets as well. So far, we're seeing tentative signs of recovery from the impact of COVID-19. Several industries are emerging as frontrunners, and investors are taking note and taking markets to record highs. But it's important to highlight that there's still this disconnect, right, between Wall Street and Main Street, because while something like the latest jobs print stateside got investors spooked, it's the fact that it's likely to push any tapering of stimulus further down the road that's acting as a lifting force while we wait for that economic recovery to really come through. And it's that force that's taken our local market right here in South Africa upward too, for now at least, despite any local risks and local fundamentals that are providing less than a solid ground. But even with that kind of tailwind that's fueling the sales here, offshore returns are outperforming local funds. So what happens when something like easy monetary policy, stimulus, unwinds? Well, amidst all the uncertainty around the where to from here, over the next hour, we're going to be reviewing some of the key trends that are likely to deliver superior investment returns in the months ahead and really explore investing offshore to build your wealth. So, on behalf of Business Day, Financial Mail, and Brenthurst Wealth, once again, welcome to all our viewers who've joined this morning as we try and bring you some varied perspective. Just a brief introduction to our guests this morning who are going to be sharing their insights. Greville Ward, partner and head of HNW International at Fundsmith. Anthony Ginsberg, managing director at GinsGlobal Index Funds. And then Magnus Heystek, co-founder, director, and investment strategist at Brenthurst Wealth. So welcome to you, and thank you for joining us this morning. Ladies and gentlemen, just looking at the format of today's program, while the speakers are going to be making their presentations to you, we do encourage you to participate in the conversation as we go along. So please send through any comments or questions you might have for our esteemed speakers while these presentations are underway. And after their presentations, we'll be tackling as many of them as we possibly can as we wrap things up in some more open conversation in the last 10 to 15 minutes of the session. So be a part of the conversation and interact with us on the live chat via the live chat room on the side of the live screen. And please don't forget to mention which speaker you're directing your question to before you pose it. Just a few housekeeping matters for some Zoom etiquette. Speakers, please have your cameras on from start to finish, but have your mics on mute unless you're speaking or responding to a question. You'll be controlling your own mics throughout today's session. So without any further ado now, with this focus on building global wealth, I want to hand over to Magnus Heystek to really kick things off. Just a brief introduction to Magnus. Magnus is co-founder, director, and investment strategist at Brenthurst Wealth, a company that was established in 2004 and manages more than 10 billion rand on behalf of clients. He's authored several books about investing, retirement, and personal finance, and is an established public speaker about money and investment-related topics. Before establishing his own companies, he had a distinguished career as a financial and business journalist and lived in my world for a bit. In fact, he founded one of the first investor clubs in South Africa while at this time, has been involved in investment, financial planning, and personal finance for individuals since 1994. With that introduction, Magnus, it's over to you.
Alishia, thank you very much for that introduction, and nice chatting to you over Zoom. Before I start with my slides, perhaps a bit of a history of offshore, onshore, as far as South Africans are concerned. And I always say that prior to 1994, South Africa was a rand-locked country. In other words, having offshore assets or offshore investments was illegal, and people went to jail for having offshore assets. So 1997, the Reserve Bank introduced a 200,000 Rand allowance and gradually pushed that up 400, 800, and it went up to 1 million, 4 million. And in 2015, actually, when they pushed up the limits to 10 million Rand per person or 20 million Rand per family unit, they actually opened up the floodgates for South Africans to invest offshore. And I think that was a turning point for many individual practices like ours to really seriously consider taking money offshore. But having said that, we've been in the markets for a long time. But from 2002 to 2008, our market did so well, the rand was strong, commodities were running. It wasn't necessary to, by and large, to consider offshore. The big turning point, in my view, came in great financial crisis, 2008, and changed everything. It put an end to the commodity cycle, the boom. There was a bit of volatility between 2008 and 2010. And since then, markets have gone different ways. Global markets, primarily the United States, NASDAQ, S&P 500, driven by phenomenal new companies coming to the markets and established companies in the infotech sector, just absolutely dominating markets. So there was the first impetus for us at Brenthurst to start sending money offshore because we could not get that in South Africa. That was, let's call it the first period of offshore diversification. I also attended an investment conference hosted by John Malden, who spoke about biotech and related developments taking place. And I started writing on MoneyWeb and other places that you should take some of your money offshore. That was driven purely by the economic and financial fundamentals. 2014, 2015, the political situation in South Africa started having an effect, and that I started writing some newsletters about this. And, I started warning that in addition to the financial situation, one needed to start looking at the political situation as a factor in your investment decisions. So if I can just get my slides going, I wrote an article in MoneyWeb 2014 where I said bad things are happening or can happen to good countries. And that article was the start of several articles that South Africans should consider offshore investing. I got a lot of pushback from the media. Rapport had a piece on me, and even my colleagues had a go at me saying, what are you talking about? The JSE, South Africa, wonderful place to be. But that's not what I saw in my slides. And even Financial Mail, who's co-hosting this today, had a slight dig at me, calling me SA's Dr. Doom. And I just laughed it off. But the problem is that I do not work, or Brenthurst does not work for one of the large asset management companies. We work for our clients. Our clients rely on us to analyze financial trends on a global basis and try and find them the best investments with the lowest possible returns. And I said, I do not see that in South Africa, considering the damage done to South Africa and the economy and the fabric of our economic situation by the Zuma years. And I said, take some of your money offshore, if not all. And that's just how it came about. I had a little jousting with my friend and colleague, Alec Hagen, Business News. We also differed. And I kind of stuck my neck out and said there is financial difficulties ahead for South Africa. And this was written well ahead of the COVID crisis. There were other economic factors. That's just as a bit of a background to my views. They were not anti-South Africa. I have to stress that. I live in South Africa. My kids are here. My grandkids are here. And I have many assets in South Africa. It was as a result of the ANC's economic policies that I was forced to take money offshore to find the best returns for my clients. Let's just put this into context. Here's a slide, and you people can get this later on our website or on the Business Day website. But currently, the South African or the Johannesburg Stock Exchange is the 20th largest stock exchange in the world by market cap in dollar terms. We are now, or we have been overtaken by smaller stock exchanges previously, like the Tehran Stock Exchange. I didn't even know they had a stock exchange, and also Taiwan Stock Exchange, etc. So when you compare us relative to the rest of the world, South Africa, the JSE is falling back all the time. So at $1.1 trillion market cap, we're much, much smaller than the New York Stock Exchange at a $26 trillion market cap. What cannot be denied is that since 2015, foreigners have been net sellers of both equities and bonds on our market, and the outflows have been substantial. Equities, 5 years to date, 539 billion rand. That was before last month. There was an additional 10 billion last month. So we're up to 550 odd billion rand has been sold off from the JSE, partly explaining the weakness in the JSE and to a lesser extent the bond market. But another worrying factor is that in the run-up from 1990 to 2001, we had a surge of new listings, new capital was being raised by the market, which the market should be doing. But since 2001, it's been a gradual decline, and the number of listings down to 310, essentially where we were in 1992. So from a purely technical point of view, our market not only experiencing an outflow of money, also the number of listings and the opportunity set is shrinking very rapidly, to such an extent that JSE boss Leila Fourie last week said this is a major concern to her, and that we should make the JSE or the economy more investor friendly. Having said that, this is the return graph that should worry South Africans. If you compare the JSE All-Share Index with the emerging markets, Europe, World, S&P 500, we are stone last. If that was a race, the comrade race, the winners already had a shower, they're already having their second beer, and we're still halfway running up Cowie's Hill. So whether you price our market in dollars over 10 years, 5 years, even 15 years, there has been very, very little growth in international terms, which is very important to us and our clients. The same with the Rand returns. We've just, grown at 6 or 7%, strip out inflation. The real growth has not happened in South Africa. And again, this needs to be pointed out, and I think, Alishia, you do this quite often, and other columnists, but there still seems to be a lot of pushback against people calling it as it is. Here's a little exercise I did with 10,000 Rand invested 5 years ago, and I'm using the Allan Gray Fund not to pick on them, but purely because they're the biggest equity fund. Had growth of 4.9%, Rand value today 12,478. And if you compare it with the other three indices, you can see for yourself the vast underperformance experienced by South African investors over the last 5 years. Even worse, over a 10-year period, and don't cry when you look at the returns of the NASDAQ, that over a 10-year period, your 10,000 Rand has been turned into 132,000 Rand, S&P 500, 76, World Index 59, and South Africa, whether you use a fund or the index, barely doubling its money over a 10-year period of time. So we've been hammered. Yet from time to time, I get slammed by people, columnists, who have a go at you and saying that the Aussie is a place to be, and so it's just the narrative sometimes can be quite vicious, and it's ironic that since and I did this exercise this morning Had you taken your money out, which was theoretically impossible, on the 19th of March last year in the middle of the COVID pandemic when the Rand was 1932 and invested in various asset classes across the world, you still have not beaten the offshore markets, especially the Fundsmith fund, which is still giving you a better return. But be that as it may, there's a lot of pushback from people who have a vested interest in convincing people not to take their money offshore. But we have, as a counterbalance, we have the editor of the Financial Mail, who wrote very recently a very objective and critical analysis, who asks the question, who dares to invest in South Africa now? And it's a valid question because it will determine how you retire, the quality of your life, the quality of your children's lives 5 or 10 years from now. I would like to end on a note that if the market conditions change to such an extent that we can start recommending South African investments again, we will do so. But we need to stress that we're independent financial advisors. We do not get paid by anybody but our clients, and they expect us to handle their money with integrity and objectivity, which has to be based on a critical analysis of the facts in front of us now. And before I hand you over to Greville and then to Anthony, at Brenthurst we have been, and by the way, we've twice been voted the top boutique wealth manager in South Africa, been second once, been third a couple of times. Our clients appreciate what we do. And we have been following and investing along global investment themes as opposed to the market cap approach where we look for markets and try to beat the various benchmarks. That strategy, by and large, has been changing over the years. And some of the themes that we found, you will find it in Anthony's funds and Fundsmith's funds and other funds as well. So with that, I hand you over to our next speaker, Alishia. Thank you very much.
Thanks so much, Magnus, for that. And of course, one of the things that just stood out from that presentation, where you've, of course, laid out some of the context here, is that even if you invested your capital offshore on March the 20th last year, with the Rand trading at its weakest levels ever, you would still have managed to beat the local market. And I think that's something that really stood out there. Before I bring in our next speaker, Magnus, ahead of the event going live, someone asked a question on Twitter: should we be watching the session if our income wealth falls below a certain threshold? And if the answer is no, what is that threshold? And I thought it was interesting because, you know, we often get viewers writing in to tell our market watchers to stop stock picking international shares because they're unaffordable. So Magnus, before I let you go, what would your response be to that kind of a question that's out there?
It's a very valid question, but we advise the children of our clients, and even my own children, with a small amount of money, you can invest in an offshore asset swap in South Africa with as little as 500 Rand, and with a bit more money, you can buy a global ETF like Anthony runs. You know, there are many, many options. Easy Equities runs funds that you can choose. So price is not really a factor. It's understanding what you're investing in. And when my kids were growing up, I had invested in them offshore for a long time. I would sit and say, come here, my darling, I've invested your money in the following funds, and I would show them the top 10 holdings. And when they see Apple or Google or whatever, they understand that the product that they have in their hand, their cell phone, they're actually indirectly investing them. And they've stuck with their strategies, and they've built very, very nice nest eggs with small but regular investments in those offshore instruments.
Okay, so thanks for that, and hopefully the viewer happy with that answer, that you know, there's no discrimination here, and you can get involved with any any amount at any time. Right, for a closer look now at some of the global themes in play, Greville Ward, who's partner and head of HNW and International at Fundsmith, is going to be taking us through what that's looking like from his view on the other side of the world. Now, Greville spent 25 years in European equity sales, first in London, before moving to New York back in 1988 to work for BZW. He's been the head of European and Eastern European sales at Robert Fleming, joined Bankers Trust until their takeover by Deutsche Bank in 1999, and followed all of that up by starting the US operations of Collins Stewart. Now, since leaving Collins Stewart in 2007 and before joining Fundsmith at its inception in 2009, Greville worked for a London-based intelligence company. And Greville, the stage, or the screen, I should say, is yours.
Thank you very much, Alishia, and thank you, Magnus, and thank all of you for joining us on Thursday morning. It's a pleasure to be here, and I'm going to spend the next 15 minutes talking about Fundsmith, the Fundsmith Equity Fund, and what we do, and I'll be happy to answer some of your questions afterwards. Fundsmith was started in 2009, end of 2009, and we launched the first fund, the Fundsmith Equity Fund, on the 1st of November 2010. So we've been going for about 11 years. We have offices in London, where we started, in Mauritius, where I'm based, and also in Connecticut in the USA. We have about 50 people who work for the company, and we have assets under management of about $55 billion in round numbers. The fund was started by Terry Smith, who is fairly well known in the financial community, not least because in the early 1990s, he wrote a book called Accounting for Growth, which showed how easy it was for companies to create the illusion of profitable growth when no such thing was going on. The book became sort of fairly well known. And is in some way what he wrote in the book is the basis for what we do at Fundsmith, which is very detailed bottom-up research. The Fundsmith Equity Fund was started on the 1st of November 2010, as I mentioned. It is a global long-only buy and hold fund, and we are always fully invested. So we take no macro view. We are trying to find the best companies in the world, somewhat going to what Magnus was saying a moment ago. We don't have a home market bias investing in UK companies. We're just trying to find the best companies in the world and invest in them for the long term. There is a disclaimer which you can read later on if you so wish. This is showing the performance of the Fundsmith Equity Fund since we started, and year to date. Annualized return, these are in sterling because it's a sterling-based fund. Annualized, we've produced 18.9% return against equities, which is the MSCI World in sterling of about 12.8. And I think when we started the fund, we thought that the most likely period where the fund would do well, given the somewhat defensive nature of things that we invest in, would be when the markets were tricky or even going down. But it's gratifying to see that the fund has actually beaten even rising markets since we started. And there's a reason for that, we think, which I'll come on to in a little bit. The fund is 29 holdings, and we only have found 73 companies in the world that we think are investable. What do we mean by that? Well, if you're a buy and hold fund and you are buying things to own for a long time, you want to make sure that the underlying assets, the companies in this case, are growing intrinsically a little bit every day. And that is quite hard to find in the public markets. The reason for that is that we think the best companies in the world are private, not public. If people on this call started a new business today and the business was very successful and it was growing through internally generated cash flow, then there's no particularly good reason for you to take that company to the stock market. If you do so, essentially you're sharing the spoils of war. And so, unfortunately, if you're investing in public markets, which is what we do, it's fairly slim pickings finding really good businesses which you know are growing and compounding every day. On Bloomberg, there are 64,000 securities, and that's where we start our search to try and find good businesses that we can buy and hold. And as I mentioned, we only have found 73 of those to date and are invested in 29 of them today. Now, I'm not going to talk about attribution for the moment. This is the three-step strategy that Fundsmith employs. I'm going to talk about each of those individually briefly. Only invest in good companies, don't overpay, and do nothing. It's pretty easy to say. It's a little bit harder to execute. The first one, only invest in good companies. Well, don't all fund managers say that they only invest in good companies? They may say that, but it's not demonstrably true in many cases. Our definition of a good company is a company that makes a cash return above its cost of capital throughout the business cycle without the requirement for leverage or borrowing, and with the ability to reinvest in order to grow and compound. So all the companies that we invest in are making cash return above their cost of capital, whatever's going on in the world. So whether there's a global financial crisis in 2007 and 8, or whether there are other difficult macro things going on, the companies that we invest in, we know are still growing intrinsically a little bit every day. And that's really about the only thing that we at Fundsmith ever promised our investors, that all of the 29 companies that we currently own are bigger today than they were yesterday. They will all be bigger tomorrow. They all make their money out of a large number of everyday, repeat, predictable events. And so hopefully everybody this morning brushed their teeth. Hopefully they've fed their pets. They're probably drinking soft drinks. They might have a hard drink when they get home this evening. They may be wearing leisure wear made by Nike when they go to the gym. All of these things are happening every day, irrespective of who's in the White House, what the level of interest rates are, almost irrespective of COVID as well. So we only invest in companies that whatever's going on in the world, we know are a little bit bigger today than they were yesterday. The second thing is don't overpay. This is important, but it's not as important as the first. If you invest in really good businesses, you can actually pay the wrong price for them, and you may well be okay. We're not encouraging people to do that, and we're not doing that ourselves. But the price that you're buying these companies is somewhat less important if they are compounding at a higher rate than the market. I can illustrate that later on if need be. But only invest in good companies, don't overpay, and then do nothing. Do nothing is quite difficult in the active fund management industry because there are lots of people trying to encourage you to do things as an investor, encourage us to do things as an investor. Buy this, sell that, change your strategy, invest in something different. Now, the reason that we do nothing in our fund is because we've been, as a group that started Fundsmith, we've been in the financial services industry for a long time, and we've never met anybody who was any good at market timing over the extended period of time. In fact, we have an expression at Fundsmith: there are only two types of market timers, those that can't do it and those that don't know they can't do it. There's no third category. And so on that basis, at least we know we can't do it. So if you're not trying to predict where the market's going, you are by definition a happier investor. And if you're invested in things which intrinsically are growing a little bit every day, then we think you get a better result doing nothing, because there's a frictional cost of turning over your portfolio all the time. It costs you money to do that. And secondly, you've got to keep having better ideas than you had last week or last month. You've got to sell this, buy that, sell this, buy that. And we just don't think that anybody's any good at that. So for as long as we're sure that the small number of companies that we are invested in is getting bigger every day, we think the best investment strategy is to do nothing. And so that's what we do. We say we invest in good companies, but you need to be able to back that up. Otherwise, it's just words. And the top line is the most important here, the return on capital employed. Warren Buffett, in his 1979 investor letter, said return on capital is the most important determinant of whether a company is doing a good job or not. And so if you look at that top line, this is the Fundsmith Equity Fund. So we're treating it as if it was one company. On average, return on capital employed is 27, 28, 29 or so. It dipped slightly in 2020, obviously because it was an exceptional year, but it's still significantly above the S&P 500 and the FTSE 100 over on the right-hand side. Our companies in general also are better than the market in terms of gross margin, operating profit margin, cash conversion, and interest cover. And so if you own a better subset of the market than the market, it's no great surprise that if you're a medium-term investor, you should be hoping for a slightly better return than the market is producing. And so that is really the most important slide that I'm going to show today. It's the most important thing that I think that we do at Fundsmith, is to show people that we own good companies, and we can back that up with those numbers. And we actually publish this chart in the annual letter every year. But if you own really good businesses that you know are growing and compounding, then the best thing to do is nothing as an investor. In valuation terms, the fund trades on a free cash flow yield, which is the valuation measure that we use. We much prefer it to P's. about 2.6. It is a little bit higher than the S&P if you strip out financials, but we do believe that we have a better subset than the market, so we don't mind the fact that it's a little bit more expensive. We believe that the return that the fund should be producing, I'm not promising here or projecting, but I'm just telling you the sum that we do at Fundsmith, is something like the free cash flow growth of the portfolio added to the free cash flow yield. So if you take 8%, which is the growth last year, add it to 2.6, you get between 10 and 11. That's roughly what the return we think the fund should produce is. Would you take a 10% compounded return over the next 10 years? I would hope that most investors would. And the reason I put that slide up is just because those metrics, even though everything's got a bit more expensive, clearly over the last few years, those two numbers added together for our fund are not dramatically different to when we started. When we started, the free cash flow growth was a little lower, the valuation was a little higher. But I just think it's important for people running around with their hair on fire saying everything's ridiculously expensive. It doesn't look so to us, and that's really why I put that slide up. We do nothing. We try and do nothing in the portfolio, but we don't literally do nothing. Obviously, we're doing research every day, and we do make changes to the portfolio, mainly 2 or 3 stocks in the 29 stock portfolio every year. I just wanted to highlight in 2020 that we bought 2 new positions, Nike and Starbucks, both of which were companies that we wanted to own for a long time, but were too expensive for us. And we got the opportunity in March, when the market was having a difficult time during COVID, to buy them at what we thought were attractive valuations. And we actually sold 2 stocks, Clorox and Reckitt Benckiser, that both had a sort of COVID bounce because they both made cleaning products and sanitizing products and so on. And they did very well with that, but we didn't necessarily think that was a long-term trend. I certainly hope it isn't. And so we used the opportunity of the strength of those 2 to sell them and reinvest in 2 things that we've wanted to own for a long time. Just to give you an idea that we're always on the lookout for companies that we think are great, that are trading at a level which is historically attractive. In terms of sector, we mainly invest in 3 sectors: old line technology, which is really installed bases of software, things like Visa in payments, PayPal in payments, Microsoft because of the cloud and so on. We invest in consumer staples because when your toothpaste runs out, you go and buy more. When your dog food runs out, you go and buy more. There's no other option. And we invest in healthcare because same deal. If you're not very well, you have to go and see the doctor or go and have a procedure. It's not a very economically sensitive thing. And those are the 3 sectors that we mainly find what we're looking for, these long-term compounding companies. There are a large number of sectors we will never invest in, with apologies to the South African market, because some of these are heavily featured in the South African market, but we will never own a bank, an insurance company, no utilities, big pharma doesn't really work for us, biotech, steel, chemicals, oil, mining, minerals, airlines, most technologies out for us. We only own old technology companies, not new ones. Media doesn't work for us, real estate because of the leverage. All of those sectors, we just don't really touch. We are mainly in old line technology, installed bases of software, consumer staples, and healthcare. Those are the areas where you can find these great businesses that you can invest in for a long time. In terms of geographical split, we're heavily in the US, which I know Magnus mentioned a few moments ago, not because we're taking a big bet on the US or did at the beginning when we started Fundsmith, but just because if you want the biggest sort of old technology companies in the world, the biggest consumer products companies, the biggest healthcare companies, they happen to be based in the US. We don't really care where companies are listed. It's where they do business that's important to us. And on the right-hand side of that slide, you can see that we do have emerging market exposure, Asian exposure, but in terms of listing, we're heavily weighted to the US because that's where the companies happen to be based. Just very quickly to end on a couple of things. One is the organizational chart. I put that up just because even though Fundsmith is a small company, we do have 2 or 3 other fund managers in the building, as it were. So although Fundsmith was started by Terry Smith, he is the Chief Investment Officer, he has a very good team of research analysts around him. And we do have some other funds, which I'll mention in a second. And we have people who are actively running those funds. So people often ask, maybe already somebody sent a WhatsApp message saying, what happens if Terry Smith falls under a bus? We have a succession in place. Julian Robbins, our head of research, and we have other fund managers in the building who could take over if anything happened to him. But I was just going to end on the fact that it's not the only thing that we do. We do also have a sustainable version of the fund, which takes out sin stocks, if you like, from the portfolio, or as I like to say, it takes the fun out of Fundsmith. But for those that prefer that type of investment, we have a sustainable equity fund, We also, on the left-hand side, have a UK-based investment trust, which is a smaller mid-cap version of the same strategy, so buy and hold, but slightly smaller businesses, because in the main fund, we're only talking about essentially global mega caps. And then over on the right-hand side, we also have an emerging market fund, which we started about 5 years ago. But again, it's a buy and hold fund, but using emerging market, mainly consumer companies. So that is what Fundsmith does. I'm going to finish 27 seconds early. And if you have questions later on after Anthony's talk, I look forward to answering those. Thank you very much.
Thanks so much, Greville, for that presentation and that oversight or insight into the environment and how you're, delving into things. A lot of questions have been coming through, particularly pertaining to the parameters of investing offshore, also how to and the practicalities, to tackling this offshore market successfully. I'm not going to take too much time because we've had a flood of questions come through, and we want to have enough time at the end to tackle as many of them as we possibly can. So I'm going to pass the baton now to Anthony Ginsberg. He's Managing Director at GinsGlobal Index Funds of South African origin. Anthony started his education and acquired his qualifications right here in South Africa, but then qualified as a certified public accountant in the US after working for the investment bank Solomon Brothers, which is now Citibank. He then served as Barclays Bank's director for offshore services, and now with the GinsGlobal Index Funds manages over $4 billion of assets using products and designs created by GinsGlobal. The company is a leading index product design and asset management company dedicated to passive index fund investing and ETFs, and has operations in 10 countries, including the US, UK, the Netherlands, Germany, Italy, South Africa, Sweden, Israel, and Mauritius. With that, Anthony, it's over to you.
Hi, good morning, Alishia, and it's great to join you from LA here in California. I guess the new world economy. As an old boy, ex-UCT man, former Cape Townian, I have one little quick tidbit to tell you. Magnus and I go back a long ways. I'm always grateful to South Africa because I got my start there in doing a business science and finance. And Magnus, you may remember this, even though we've both got some gray hairs since then. I think we first met when I was a very young man. I was very lucky. I had a tax haven book published by Butterworths in the UK back in the early 90s. And you very kindly did a very warm interview on Radio 702 back in the day. So, it brings back a flood of memories. Thanks for having me on. My task today is to really talk a little bit about trends and thematic investing and why it's become more popular internationally. I'm just going to share my screen, Alishia. I'm very happy to take questions, of course, as well. What I wanted to just mention is we're an index fund company. Some people wonder what that is. Over the last 25 to 30 years, index fund investing, which tracks indices such as the S&P 500 or the Dow or the FTSE in the UK, have typically outperformed between 80 to 90% of most active fund managers over a 10-year period. It was slow to come to South Africa. I'm happy to say we started around the same time that Satrix began, but we were the first range of offshore index funds really approved by the old FSCA in Pretoria many years ago. It was called the FSB at the time. So we work with a number of large South African institutions, banks, and insurance companies, and we feel it's a safer, broad-based way of investing. We're not picking sort of superstars and overweighting them. We typically have close to 100 stocks in our index fund products, particularly the thematics I'm going to talk about. The Tech Megatrend ETF, it's listed on the London Stock Exchange as well as the Swiss Stock Exchange in Milan, and also on the Frankfurt Exchange. And it's priced in dollars, euros, or in pounds. It trades every single 5 days a week, and you get your money in and out. There are no entry or exit charges. What I thought I'd just do is walk you through what's going on in the world of technology and megatrends. Clearly with COVID, many people believe, and as we do, that the tech disruptors have been the major beneficiaries of COVID. We've seen the likes of cloud computing and cybersecurity winning in a huge way. They've been powering the NASDAQ. I just want to mention one thing. Indexes are designed in many cases by market cap, meaning that the largest firms will largely dominate the index. And you have a situation in the US at the moment that makes some folks a bit nervous that the NASDAQ basically has about 9 companies representing more than half of this NASDAQ technology index. These are the FANGs: Facebook, Netflix, Amazon, Google, etc. And what we've tried to do is to really equally weight our thematics and our technology products. We found that the European investors and the non-American investors that we typically invest for are maybe not as gung-ho or as aggressive as my fellow Californians who are living and breathing Teslas every day here in Beverly Hills or in Santa Monica. So we've tried to actually offer a more diversified approach, and it's called equal weighting. So we will have, in this megatrend fund, there are 114 holdings, and we've got 8 sub-themes, which I'll get into in a moment, that are equally weighted. So we're not betting on one particular theme. We think it's very, very difficult to time these particular themes. But just very quickly in a summary, there's a shakeup going on in the healthcare industry in the US as well. And big tech, the likes of Microsoft and Google and Amazon, are all buying in to the healthcare space. Healthcare, many of you may not know, represents about 21% of the US GDP or the US economy. And it's very, very slow and inefficient. In fact, Americans spend twice as much on healthcare as the rest of the world. So we see a technology having a huge disruption and influence in the healthcare shakeup that is coming under President Biden. The Democrats in the US are big believers, even Obama was, in providing more universal healthcare. At the moment, there are almost 40 million Americans that don't have healthcare. And if you get sick in California, but you're from New York, your records aren't even shared. So it's rather embarrassing actually for America not to have a very robust IT system for their healthcare industry. The other quick thing is that the hardware component of technology has seen a rapid drop-off during COVID and a huge expenditure, the likes that many could never have predicted. Essentially, the fast tracking of cloud and the work from home trend we see continuing. I still believe I'm probably only about 10% of the Beverly Hills workforce right now here in California. It's still pretty dead in areas of LA. Even the freeways aren't what they used to be. And many people don't see it coming back ever as strong, including business travel, I might add. Another big area, I've got 3 young kids who live and breathe digital entertainment. So from the Netflixes to the Hulus, which is another online entertainment device here, to all the gaming devices. And interestingly enough, Hollywood is now only 1/4 the size of the global gaming market. So if you've got kids or grandkids who are living and breathing games, they're actually catching up to the Asian population. The Asia Pacific is actually the fastest growing region in the world at the moment for both cloud computing and digital entertainment. It's partly a result of their 5G and their very fast broadband that they have. And just lastly, President Biden is banning diesel and traditional cars from 2035 in this country. So there's a massive shakeup going on, not just Tesla, but Volkswagen, Toyota just earlier this week announced another $10 billion of R&D expenditure in electric vehicles. So we've basically taken 8 hot themes. I'm going to go down to the next slide. These are the themes from future transportation or electric vehicles to digital entertainment, social media, which is Facebook and many others, robotics and AI, blockchain, which we can get to. Genomics is something called gene sequencing or gene editing. Many of you may have heard about it. It's becoming more and more mainstream within the medical industry. And we call it customized medicine. That is the next evolution where people can actually be treated with slightly different medications from their next door neighbor based on their gene makeup. And then, of course, cybersecurity has been very, very dynamic and fast growing. We see cybersecurity, incidentally, and cloud computing as being interrelated. The more remote working that occurs, the more there's a likelihood of hack attacks. In America, of course, it had some major hacks. The Colonial oil pipeline recently, we had something called SolarWinds, which just went into about 20 different US federal government departments. We had a huge meatpacking scandal with hacking as well. So there's a part of the Biden budget that's being passed at the moment will have somewhere of the order of $100 billion or more for just cybersecurity alone. And again, he's also devoting more money to EV vehicles and subsidies, car subsidies, so it'll be cheaper to buy electric vehicles. This just summarizes the sub-themes that we have and their contributions year to date. Just to give you an idea, this fund, the tech megatrend, iTech for short, has actually outperformed the NASDAQ over the last 2.5 years. One of the reasons is that we basically equally weighted genomics, which is gene editing. You can see it's performed almost 24% just for this year alone. Cybersecurity is up 17%, future cars around 16%. The standout performers were also robotics. Let's just talk quickly about robotics. With the problems of COVID and the supply chain difficulties of getting goods across from China during the shutdown, more and more American manufacturers are onshoring their manufacturing bases. But American workers are rather expensive. You pay for health care for your workers here and various pension costs as well. So it's a lot cheaper to have an industrial robot in your factories. And we're seeing a huge take-up in demand for industrial robots here in the US, the likes of which we haven't seen ever. I would say the Japanese and the South Koreans have been the leaders in robotics in terms of automating their factories. It's coming big time into the US market. And then lastly, blockchain. It doesn't mean what some people think with cryptocurrencies. It's broader than that. It's digital ledgers. Being a former accountant, I'm a big believer that digital ledgers will become more and more efficient and disintermediate some of the costs that financial services impinge between different transactions. So blockchain has done very, very well this year as well. Alishia, I know I just have a couple of more minutes. On the healthcare side, this is an example of why our healthcare belief is very strong in both gene editing, but also in biotech. So we have a separate healthcare megatrend fund, and it's obviously been largely benefiting from gene sequencing as well as biotech. We were fortunate to have the likes of Regeneron and BioNTech holdings in there. But ultimately, as an index fund provider, to provide people outside of the US and foreigners exposure, we're big believers in having broadly diversified funds. Our tech megatrend, you can see since 2016, not every year will it be top of the pops. They're going to be individual sub-themes. You'll see in 2016, digital entertainment, followed by robotics were the best sub-themes. But over the period of the last 5 years, iTech has been a top 3 or 4 performer. It's a very steady eddy by equally weighting all these various sub-themes. So we're not huge believers in just playing one particular theme. We think that's too narrow. It's too difficult to time. One year they're top of the pops, and then the next year right down at the bottom. So tech megatrend for us, known as iTech on the London Stock Exchange, is really not just a steady eddy, but it's actually risen to the top over the 4 to 5 year period you're looking at there. And we're happy to share these slides. Just lastly, this slide shows that electric vehicles are predicted to be at least 1/3 of all car purchases by 2025. And if we go out to the end of the decade, they will be half of all car purchases globally. The US is still behind the Chinese at the moment, and that's one of the reasons why President Biden and the Democrats are having a huge push here to outlaw traditional vehicles. They really want to catch up to China being the leader currently in the EV space. And I have a slide briefly on cloud computing. Some people think, well, if COVID is going to be over soon, surely everything goes back to normal. That's not the case. We see cloud computing, which is subscription-based, being far cheaper than IT being brought in-house to companies who have to continually upgrade their hardware and even their software. So something else that cloud does, which many don't realize, is it provides cloud security and relates to cybersecurity. They're actually cousins. I would say cloud computing and cybersecurity are increasingly interconnected, but the compound annual growth rate is expected to be close to 20% over the next 5 years. I think that's pretty much the last slide coming up, which is about the record-breaking number of hacks that we've seen here in the States. We call them breaches. And just in 2020, we had essentially something like 8 times the level that we had in the mid-2014s, 2015 period. So there's a huge amount of expenditure going on in cybersecurity. And I can tell you that the health insurance industry, again, that's an area that compromises almost 1/5 of the US economy. They are the fastest and biggest spenders of both cyber security software as well as cloud computing. So everything from telemedicine to wearables, these things all utilize cloud computing, which essentially is utilizing a third-party service. Incidentally, Amazon today makes more money, not from my wife or your family buying up stuff into their driveway or their front door. They actually make 60% of their profits on cloud computing, renting out their servers and their IT capacity. So it's a massive area. The big boys are Amazon, Microsoft, and Google still, but there are a lot of young and smaller, exciting players in the cloud computing space. With that, Alishia, I'll return it to you. Thank you.
Thanks so much for that, Anthony, and for sharing that perspective. We've had the questions rolling through hard and fast. So I'm going to delve straight into it because all of this, culminates in us open things up a little bit to our viewers that have joined today. And like I say, the questions have been coming through this chat room as the three of you have been making your presentations. So we have quite a bit to tackle. I'm going to jump straight into things now. And perhaps let's start off with a broad one, Magnus, because like I said, a lot of questions coming through about parameters and how you actually, start delving into this offshore opportunity, right? So how much can one person take offshore in a year? Another person writing in, my living annuity limits a foreign investment level to 40%. So what do I do with the remaining 60%?
We start with the living annuity offshore allowance, which has suddenly exploded on our market, Alishia. Until fairly recently, you could get 100% offshore exposure via your living annuity. But there's a technical reason why the asset managers have now started clamping down on that, and that is because the offshore component of their funds have risen so much relative to the local market, and on asset level, they can only have 30% of the total book exposed to offshore assets or offshore. Because they've now reached that limit, most platforms have now said we have to reduce the offshore to 70, 60, and as low as 30. So suddenly it's become a problem, and people are scrounging to get offshore exposure. It's not Regulation 28. It's an exchange control limitation on offshore assets. So you have to call around and you speak to a Brenthurst advisor or your advisor. They know where to find the 100% offshore allowance at the moment, and you can theoretically move your living annuity from one to another if you want offshore 100% allowance.
Yeah. Magnus, a question that has come through, given the massive outflows, is there a danger of the SARB pulling back on exchange control regulations?
Very much so. It's a regulation, can be introduced any time. It's a pseudo-political position and also want to protect the currency and the local market. So there's always a danger that SARB, Treasury can limit that. And that's why if that happens, then the only thing that's left open to you is to use your individual allowance, which is R1 million discretionary per year. Or if you're fortunate enough to have more money, you can take it up to 10 million rand. And that goes through tax clearance. So it depends on the factors. If you can't get more via your RA pension fund living annuity, you then go with full exposure with your private cash, and that you need to remit and send to a platform like Momentum Wealth. And on that platform, you can get your Fundsmiths and your GinsGlobal funds, and then we use it very successfully. They are on that platform, but you've got to get the money there via your advisor.
Yeah. Anthony, let's take a look at this opportunity, right? The US markets are at an all-time high. GinsGlobal is a tracker fund. Is GinsGlobal building any form of protection against a big market correction, as my investment advisor has recommended? Restructuring my portfolio, which includes selling my Gins investment. This triggers a big CGT event, and I'm thus reluctant to actually go down this route.
It's a great question. No one can time the markets. There's an expression at the moment here, which is that interest rates are next to zero. And there's going to be a huge stimulus under President Biden. The Democrats are real Keynesians. I mean, frankly, America is going to have something of the order of $6 to $7 trillion being pumped into this economy over the next 18 to 24 months. You may have seen recently a huge infrastructure bill that was just approved for at least $1 trillion as well. So we don't believe that there's going to be a slowdown. In fact, the Delta variant caused the weak numbers last week. You saw the disappointing jobs report. If anything, we have a bit of a Goldilocks scenario. There's no election coming up here until basically 14 months out. The Democrats are desperate to really pump as much money into the economy and keep it going at about 5 to 6%. Many thought we may grow at 8% this year. We don't see a crash coming anytime soon. Typically, our tech funds are used as building blocks. They may not be the core of a person's portfolio. They may use the S&P 500 or some more broad-based index. The thematic investors are typically using us as a satellite approach where they may put in somewhere of the order of 5 to 15%, Alishia, into our funds. So we aren't really the problem. They probably have a bigger issue in terms of their core holding.
Yeah. Greville, you talked about investing in good companies, right? So this is one of the points you were pretty emphatic about. How does Fundsmith avoid overpaying for good companies when it has to remain fully invested? Fundsmith keeps growing asset under management and the cash must be deployed.
Yes, that's true, Alishia. Since we've started, we've always been lucky enough to find companies within the 73 that we think are investable. We found at least 29 that we think are trading at a valuation which is attractive enough to us to invest for the long term. You have to remember we're investing on a sort of 7 to 10 year view. And so we are very patient. We're not trying to select some sort of moment in time where we can buy something and 6 months later the share price is going to be higher. We're investing in the cash flows of these companies that we know are growing. I mean, our first price in Microsoft was $25 and it now trades at $300. I mean, that's the sort of thing that we're looking for, but it's taken a while to get there. If, you know, Terry has said publicly, if he can't find anything to buy amongst the companies that we like investing in at a price that he thinks is relatively attractive, he will say something. He'll say, look, I'm sorry, people, but don't give us more money because we can't find anything to invest in. But we're not even close to that at the moment. We think that some of the things that we own are trading at extremely attractive levels. So we're very mindful of valuation, but ultimately we're trying to just invest in these great businesses for the medium term. And if you are trying to do that, current valuations, we think are fine.
Yeah, so that in part, Greville, answering this next question, but I'm going to put it to you in any case, just to see if you've got anything to add. This is all history and hindsight. Is it still a good idea to take money offshore now when the US market is at an all-time high?
Well, we at Fundsmith don't take a macro view. So the reason that we're invested heavily in the US is a function of the fact that the best companies in the sectors that we invest in happen to be listed there or headquartered there. If the questioner is saying, you know, is the US stock market going to go up in the next 6 months to a year? The answer is we've got no idea. And we don't really care, to be perfectly honest. But do we think that Microsoft is likely to be a substantially bigger company in 10 years than it is today? We do. And we want to be part of that. Same with Pepsi, same with Nike, same with Starbucks. And we want to be invested in it because for us, the risk is not being invested in it. If we say, well, we think the market's going to fall, let's sell everything we've got in the US and hopefully buy it back in 6 months if the market comes down. What if the market doesn't come down? Every day that we own these things, they're getting slightly bigger. They don't know that we don't own them. If we sell them, they're still getting slightly bigger. So we believe if you're a medium-term investor, which we are, it's better to be invested in these things that you know are growing.
Yeah. Magnus, this seems to be a real concern amongst our viewers today, right? I'm concerned about the high price of overseas markets, especially the US market. What's your opinion when taking rands out and there's a US correction, because then you see a big loss in rands?
Yeah, everybody is an expert on the US market. They all know when it's high. They all know when it's low. I tell them, I don't know if it's high or low. And you just buy and you learn to, when you get older, you learn one thing, you need to be patient in markets. You're not smarter than the market. You're not smarter than a group of people who manage money. You might pick up an article here or listen to someone who has an outspoken view on the market. Harry Dent is a classic example. He's been wrong on the markets for 40 years, but every now and then he gets massive exposure. And whether the market's high or not, as Greville says, you're buying companies and you want future growth, and which makes it more difficult from the South African perspective. You still have the rand-dollar exchange rate that comes into the story, and people want you to be right on both market timing and rand-dollar strength, weakness. It's impossible. We answer that question by saying, where do you want to be 10 years from now, and where do you want your money to be 10 years from now? And you work your way back on that.
Crystal balls don't work in this environment. Anthony, having said all of that, should we be worried about regulation in China and the debt problem of China getting out of control? And this in reference to the Evergrande troubles.
Yeah. Two quick things I wanted to mention. The Chinese troubles, particularly in their tech sector, has actually led to a flow of money out of China back into the US market. We've actually seen an inflow of money into the tech sector. Incidentally, our Megatrend ETF only has about 55% in the US. We're actually globally exposed to Europe, Asia, and the Middle East, believe it or not, as well. We follow where the companies go and where they're domiciled. So the problems in China has actually led to more support of US companies. We've actually seen a significant outflow from China back into the US market. Yes, we're worried. We can't call the future of China. It's really the Communist Party that controls what's going on. So increasingly American investors, I can tell you from this side of the pond, are very nervous. They're not too sure what the next shoe is to drop there. So people are watching it very, very carefully, and there's a lot of nervousness here. Obviously, under Trump, we had a whole trade war blow up as well. Biden hasn't changed that much. Frankly, there's bipartisan support in Congress here to really remain tough on the Chinese. There are a lot of instances of them hacking with cybersecurity, as well as between them and the Russians. We're not sure who's actually the worst of the worst. So there's not a lot of support for China at the moment here in the States amongst investors.
Alishia, I can just add that the whole tech China story with its link via Tencent to Naspers has suddenly become another risk factor for South African investors via their portfolios, via pension funds. And we've seen it today, even the Naspers share price down 7-8% almost at one stage. So that's an added risk to the South African market, where you have one company or two companies with a market cap of 20% plus. And suddenly, as Piet Viljoen says, there's an existentialistic threat to Naspers. He said it can go to zero. Now, I don't think that's going to happen, but suddenly Naspers is down 40% in a year, and that is hurting portfolios, once again highlighting the risk of overexposure to the South African market.
Absolutely. Greville, a question that's more Fundsmith specific. What's the blended PE of Fundsmith?
Well, we don't actually use PEs, and the reason for that is that if you give company enough capital, it can produce any E that you like. So it's a flawed measure, and we just don't think that it's particularly important. We use free cash flow yield as a valuation because you can't kind of fiddle that, if you like. And as I mentioned on the slide, the free cash flow yield currently is about 2.6% of that order. It has come down a bit since we started Fundsmith. But then when we started Fundsmith, the long bond in the US yielded, a bit over 4, and now it yields pretty close to 0. So relative to the long bond, it has kind of moved in step. But I'm afraid we just think PEs are not a particularly useful valuation measure.
Got you. Greville, which overseas markets, in your view, are overheated and which have legs still? Is it still wise to invest in the NASDAQ right now?
Well, again, Alishia, at the risk of disappointing your listeners, we don't take a macro view and we don't take a market view. And just to repeat what I said before, we think there are two types of market timers, those that can't do it and those that don't know they can't do it. And at least we know that we can't do it. We think most investors can't do it. In fact, we've never met one that could. And so I haven't a clue what the NASDAQ's going to do in the next week, month, year. I really don't care about that. I care about the fact that we're only invested in companies that we know everybody will be using today, billions of times around the world. And thus, the price of the company, the share price of those companies, if you're a medium-term investor, should take care of itself, whatever the market does.
Okay, on that note, I think a good place to leave it. Hardly enough time to tackle all the questions that have filtered through this morning, but thank you so much for having joined us. Ladies and gentlemen, it's where we're unfortunately going to have to leave things for this morning. We have covered a lot of ground, but like I say, 1 hour, not nearly enough time to tackle absolutely everything. The investment universe is a vast one, but hopefully this giving you just a bit more insight into the kind of opportunity that sits out there and can be leveraged off, and how to start pursuing that. Once again, thanks to you all for joining this conversation, to you, the viewers, for watching and interacting, to the speakers for your participation and sharing your insights with us, and thanks to our partners, Brenthurst Wealth, for partnering with the Business Day Financial Mail Investment Dialogues Live. It's been an absolute pleasure hosting you this morning. From me, Alishia Seckam, it's bye for now.